At the May board meeting, Governor Lowe and the Reserve Board, well, I would have loved to have been a fly on the wall here because I'm sure this would have been a serious consideration. But they kept the cash rate on hold. That's right, for the 34th consecutive month, the cash rate is going to remain on hold. Now, does that mean that we're going to see the cash rate staying at this level? I predict not. I suspect the only reason why they didn't move on the cash rate was probably something to do with a small election that's going to take place in the next week or so. So it's important to understand that the economy is still not in good shape. And the reason for that we saw came out in the inflation data. So in the first quarter of this year, we saw zero inflation. Now, most commentators and forecasters predicting around 0.3, 0.4 of 1% growth for the quarter, taking the annualised rate of inflation between sort of 1.6 and 1.8. But what we did see was zero inflation, which meant that the annualised rate of inflation is currently sitting at 1.3%. Now, that's well outside the bandwidth of 2 to 3%, which is the RBA has been saying that they want to get to over a gradual period of time. But if it's going in reverse, that is not a good sign. We looked at the unemployment story for March. We saw a flat story around unemployment. That would have been another reason why they've probably held off. And also the pending rate cuts, the tax cuts, I should say, that is also going to be coming through, which will take effect from 1 July, putting more money in people's pockets. So the reality is, though, the economy is deteriorating quicker than most people have expected, and there is a fair reason for that. The fair reason is in relation to what's happening politically. The uncertainty is not good in regards to business investment. So businesses are sitting back looking at both parties and saying they're not happy around the Liberal Party in terms of their chaos and disorganisation, but they do run a good economy, versus the Labor Party with the uncertainty of all of these, new tax charges that are going to flow through and take money out of the economy. So it's important to understand that in regards to, why businesses are sitting back going, this is no good, and that's obviously seeing the economy slow down quicker than we'd all hoped to do. Now, some of the other data that we want to talk about in terms of globally, some interesting stories there. Firstly, the US, some good GDP numbers. We saw GDP currently growing annually at 3.2%. And then the other big news out of the US was the Fed Reserve's Jerome Powell. And he may have been looking at the GDP numbers as well as the employment story in the US, which is still pretty strong, when he spoke around what his intentions were with interest rates and with the US interest rates. And the story is this: he doesn't see a need for a rate cut. The markets were expecting him to say that there will be a cut, and that's obviously led to the stock market performing pretty softly over the last few days after hitting their record highs again. But he's also saying that he thinks that inflation will improve and the economy is in an okay to good position, not as bad as some people were hoping in terms of reducing the cash rate over there. Back home, in terms of our credit story, it's not a good one in regards to housing credits. So we did see a 0.2% growth in March, and that has meant that the annual rate of growth in credit for housing is sitting at 4%. Now, you think about population growth and all these people coming in, this is how bad that number looks. It hasn't been this low since the data was first created back in 1976. So that's 42 years ago. So that is obviously a story in itself, and that would be playing in the back of the minds of the RBA as well in terms of trying to stimulate the economy. We've obviously seen what has forced the economy to slow has predominantly been dwelling prices, house price correction that we're seeing. Nationally, we did see a 0.5% fall for capital cities. Annually, that has gone to 8.4%. Now, this is the highest fall that we've seen, even bigger than the GFC period, since the data set began in 1980, led by Sydney, which is now down 14.5%, and Melbourne down 10.9%. Now, what led to that correction in property prices has predominantly been the interference in the marketplace by APRA. Now, I commented and praised them for the interference that basically quelled the amount of investors that were currently in the marketplace. It was unsustainable. That job was done almost 9-10 months ago when the market started to flatten out. The job's done, guys. So Wayne, if you're listening, who heads up APRA, please listen to me and drop the assessment rate. It's crazy having an assessment rate at 7.25%. It should be down around 6.5 or 6.75 at worst. And what that will mean is that borrowers will be able to borrow up to 5% more, and that means that they will potentially be interested in buying into a marketplace. That'll stabilise the property market, because at the end of the day, this has been a manufactured correction by you and by APRA. So please make sure that you listen to that story. We're now starting to hear calls from CEOs of banks in regards to this message that I've been rabbiting on about for 9 months or so now. So that is an important story. And the other story is, in terms of how many rate cuts we are going to see, really comes down to the politics. And we talked about this before in regards to what businesses hate is uncertainty. They want direction, they want certainty, they want policies that are about growth, that aren't about slowing the economy, and that's the challenge that we have. So in my personal view, and I'm on record many times to talk about this, that if we do see a Labor government, I suspect we're going to see a deteriorating economy. I suspect we're going to see even further rate cuts. I think if the Liberal National Party get in, that will be a surprise. But I think business confidence will rebound quickly because it is a little bit of business as usual, whereas the uncertainty around what Labor is proposing and some of their policies, which, if we focus in on negative gearing and capital gains tax, are really shocking policies. They do nothing for growth. They do nothing for jobs. They do nothing for the economy overall. All they do is put pressure on house prices, and over medium term, they'll put pressure on rents going higher. So not a good policy position to be in. So hopefully cooler heads will prevail if Labor is victorious on the 18th of May. So lots of detailed news. Make sure you tune in next month when we know what's going to be happening, but there is changes afoot, and it's going to happen sooner rather than later when it comes to the cash rate. Thanks for watching.